The areas that we want to touch on, and again, this is all to do with that kind of strategic growth and growing the business out, are the areas that we're going to look at are in and around kind of international expansion, hiring of new teams, what we refer to as doubling down on your tech development, growing through non-organic growth, so acquisitions, and how you may look at that. And then we may finish, if we've got time, looking at some additional non-dilutive funding as well, just because we're aware these are kind of the key areas that businesses are fundamentally looking at the moment. Okay, cool. So let's kick on to this. So the first area that we look at here is if you're looking to grow, scale up the operations, and you're looking for new revenue streams, an implicit place to start with that is in terms of your international expansion. So entering new markets and finding new sales opportunities. Now, there's a kind of clear point here where we're entering new markets to attract new sales targets, and there's a whole abundance of tax attributes that come with that need wider consideration and wider thought. I don't know if anyone saw earlier on in the week, I gave a presentation on international expansion. I'll cover some of the kind of areas in that, plus other kind of areas, but we'll go through this at speed. So the first area when we're looking at international expansion is very much this concept of, am I trading in a country versus am I trading with a country? And we have to be very careful in terms of the approach that we take there. So when we're trading with a country, one assumes, and I'm just going to make an assumption here, that we've got a UK standalone entity. You may have other subsidiaries, but let's just assume for the moment you've got a UK standalone entity, and I want to explore new markets. So fundamentally what I'm going to do is explore markets outside of the UK. Now, the distinction between trading in and trading with is a really important one from an international tax perspective, because it will determine where and who has primary taxing rights over the entities that you have and the entities that you may require, which we'll touch on in a minute. So if I have a UK standalone entity, but I don't fundamentally have boots on the ground in any other country, right? And we'll touch on how you're creating what's referred to as a taxable presence, a PE, nexus is referred to in the US. We'll touch on those attributes in a minute and how you create those. But if you have a standalone UK entity and you are trading from that UK entity, and I am doing outbound reach to, say, US customers, I am trading with the US, right? I am not trading in the US. So if I trade with the US, I have no actual requirement to go and set up a US operation. From a direct tax perspective, I also don't need to think about setting up a local entity. That is not a requirement and is absolutely acceptable for companies to grow and scale by trading with other countries. I mentioned there about direct tax, so that's where, if we're using the example of the US, we don't need to concern ourselves around federal and state filings. However, just be aware that there are requirements from an indirect tax perspective. So if we're looking at the US as an example, there is still a requirement to potentially have sales tax filings from the UK business. And we've seen that on a number of instances in the past, where UK businesses that are not trading in a country, they are trading with a country, still have filing requirements in that country. And I've just realized that neither Emma or myself have done intros, but part of what we're going to do here is, well, we're talking about the commercial drivers. We'll then contextualize that in terms of some of the transactions that both Emma and myself work on. We work on a large number of transactions, and the reason why we can bring this to life is some of those issues that we see are real life issues that we encounter on transactions during due diligence that create indemnities and warranties. And quite often we're seeing over the last 12 to 18 months, quite a few businesses have been caught out by this, as we're acting either for later stage tech companies or VCs, acting as their diligencers and identifying the fact that sales tax hasn't been caught. So that's the main distinction between trading in and trading with. So when we're trading in, we've got boots on the ground. We actually have some trading activity, and there is a requirement for us to file locally in that country. We can touch on how you create a PE slightly later on. Otherwise, you're just trading with that entity. I guess the question that we generally ask ourselves is why and when do we set up an entity? So we touched on the requirements around PE. But Emma, are there other reasons why you may choose to go and set up a local entity, which are probably less tax related but more commercially driven?
Yeah, so there's normally 3 reasons why you would decide to set up an entity in the country. The first one would be client requirements. So client wants to engage with the local entity. So if they're a US customer, they might just insist on engaging under US law with a US kind of entity. The next reason would be you potentially, if you've got a sales entity, you might want to separate that from your main trading entity in the UK, which potentially has the IP. So you've got a separation veil of incorporation between your existing UK company and wherever you decide to incorporate your subsidiary. And then there's kind of the third kind of bit of a broader bucket. Is there a requirement to set up? Like, have you got lots of people, for example, in that country? You need to operate a payroll. Is it more efficient to do it through a local company? And there are various other kind of commercial reasons, like you might need to have a license to be able to operate in a certain country and therefore need to have a local entity.
But actually, we're just taking tax off the table there for a moment, aren't we, Emma? We're saying actually setting up a local entity might actually be driven by those commercial drivers, right? I always think about them as a push and pull factor. So is it a client requirement, a client saying to you, I want to engage under local law, and therefore moving away from, and therefore you would move away from engaging through the main, say, UK trading entity at that point. But alternatively, that push from the business where you're saying, actually, we want a separate veil of incorporation, a distinction, because if there was ever a lawsuit that was brought against us, we're then in a position where actually they could probably just, well, the likelihood is they wouldn't be able to sue where the IP is and therefore the value of the business is, but down in the subsidiary where the value isn't, and therefore we've discussed that point several times with lawyers, and I think that seems to be a well-trodden path. The third point, though, is and again, just re-emphasising this point, is that you can trigger permanent establishment and a requirement to set up a potential entity. And that happens when you create what's referred to as a permanent establishment in any given country. Generally, there are three ways that you create a permanent establishment in any country. Those are either by creating an agency PE, a fixed place of business, or a service PE, which is going to cover this at speed. So an agency PE is where you have individuals out of country, so in the US, for instance, who have the ability to substantially negotiate, conclude, and sign contracts on behalf of the UK business. That would therefore create a taxable presence in the US by virtue of having those sales individuals. Alternatively, you can have a fixed place of business, assuming that most people on the call today are from a tech background. This is mainly going to be an office location, shared working space. Other things that can be caught by are factories and warehousing facilities and the like, which I'm assuming is not going to be prevalent for today. But again, having some level of permanence in a country will generally mean that you've got some form of filing requirement that's needed. And I mentioned the third one, which is a service PE. Now, this is generally where you have entities that don't abide by the OECD guidelines, and therefore what they do is they have slightly different subclassifications of creating a PE. Examples of this are Malaysia and Philippines, which have a service PE. A service PE is fundamentally created when you have the provision of services either internally or externally within a given country. So for instance, if you were to set up a dev center in Malaysia, you are likely to create a permanent establishment in Malaysia by virtue of the provision of services by the Malaysian dev center back to the UK business, and therefore just need to be aware of that. So that's the main ways that we create a permanent establishment in country. If we trigger a permanent establishment, we then end up having a decision, which is, do I need to set up a local entity or should I set up a branch of the UK business? Now, a branch is basically an extension of the UK business, and there are a number of tax advantage reasons why you'd set up a branch, but quite often the points that Emma raised before, those commercial points, actually override some of the considerations, and most people will then consider and move to local entities within countries. So therefore, just going back to the main point here is why we want to grow the business. We want to look at future acquisition targets in terms of revenue conversion, setting up entities overseas, obviously is an area or an international growth. Now, we've touched there on trading in and trading with, some of the commercial reasons. We've done very high level around creating permanent establishment as well, just so that we've completed the suite of international areas that need to be considered. Just be aware of two further points, which are tax residency and transfer pricing. So when you set up local entities, what our suggestion is that best practice dictates that you have that each entity that you have is centrally managed and controlled locally. What I mean by that is, say, let's go back to the example I've had before with the US. If we have a separate US entity, it is advisable that you then have a separate and distinct board meeting for that US operation. Therefore, proving that that entity is centrally managed, controlled in the US. The reason for that is that then basically will help with the support of the argument that that US entity is tax resident primarily and solely in the US. The issue is when you don't have that issue, and Emma's going to touch on this slightly later on, when you don't have that, there is a blurred line on who has primary taxing rights of an entity. And that's a position that you want to avoid. With the US, we have to refer to the Double Taxation Treaty. In there is a process that's referred to as MAPS, Mutual Agreed Procedures, where fundamentally you need to get the IRS and HMRC in the same room, who then debate who has primary taxing rights, and they will fundamentally look at who has central management and control, which, as we said before, is the overriding feature that's determined by where the board meeting is fundamentally undertaken. So really important that actually as you scale your operations, you think about that and you put these plans in place right from the get-go. There have been too many instances that we've seen where we've rolled into transactions, it's come up as part of the review, and unfortunately, it's something that we then need to be involved in terms of extinguishing that at a later stage, which can be exceptionally costly. Because if you imagine a situation where you have uncertainty over that rolling into a transaction and a diligence, then there is likely to be double tax with no credit offset between the relevant entities. But if you do know that it's not in the place that you necessarily want it to be, for instance, it actually is incorporated in the, well, it's incorporated in the US, but centrally managed, controlled in the UK, you can end up in a position where you can end up with migration or exit charges. And definitively, that's something you want to avoid, because you end up with what's referred to as a potential dry tax charge, transferring it back into where you want it to be. And we've had a number of instances where companies are gearing up for some kind of liquidity event, generally trade sale, PE flip, or even IPOs in the past. And it's been exceptionally costly in terms of looking at those areas. The final area just to touch on is transfer pricing. Generally speaking, with scale-up businesses, I have to say there is less of a requirement to have transfer pricing implemented, but there is more of a commercial overrider to have transfer pricing. Now, transfer pricing is quite a broad term, and just be careful when you're speaking to your advisors how and to what extent they are basically going down that kind of slippery path in terms of what transfer pricing might mean. Now, generally speaking, unless you've breached the limits and you're large from a transfer pricing perspective, there is no requirement to basically prepare formal documentation around your transfer pricing. And formal documentation is fundamentally around master and local files. What we suggest generally with our client base is actually having sensible, proportionate and scalable transfer pricing, which fundamentally looks at some of the commercial drivers that exist between, say, the UK company and the US entity, making sure that you identify that, you've pulled that together in terms of putting together what we call a functional analysis, which looks at the risks and rewards of each entity, documents it, and then sensibly comes up with parameters by which you would charge between the relevant entities in the group. That would be more than sufficient that I've seen in the past, unless you breach limits for most Series A, Series B businesses. I think it's really when you're getting to Series C and D. And again, the point that I'm making here is, if you start to move into a position where you're setting up local entities and you're then putting revenues through those local entities, quite often those revenues can grow at a rapid pace, but the cost base can remain relatively skinny. Now, the issue that you'll then face is that you'll end up with disproportionate levels of profitability within that entity. And in order to avoid that, you need to therefore think about transfer pricing, i.e. loading costs from the UK business into the US entity in this example, so that you end up with what's referred to, which would be the mechanism of transfer pricing, which would be a well-established path in terms of mitigating overseas exposure and unnecessary tax. I think they're the main areas. So that's our first point around internationalization. A very quick whistle-stop tour of the key areas that we think about. There are other areas, obviously, as we grow the business. If the business becomes more profitable, we need to think about how we're remunerating and repatriating profits from overseas entities to the UK, implications around how you do that, best practice, but also wider considerations around withholding tax, so you don't end up with tax leakage in any of those areas. So that is kind of the international expansion, our kind of first point covered. As I said earlier, we're going to move at speed today because there's quite a lot for us to cover. The second area is fundamentally, if you're looking to grow strategically, then making some key strategic hires is going to be one of the key areas that you're going to look at. So one of the questions that we're going to have to delve in here is, where are you making those hires? What are those hires? Where are you going to, basically, where are the hires going to be on a global basis? One of the things that we noticed as a result of the pandemic, and it seems to still be prevalent today, is that there are two implications that arose as a result of kind of hiring people on a global basis. One, we saw the relaxation of working practices that allowed individuals to work outside of the UK. So previously, people that would have been employed working from the UK are therefore allowed to work overseas. And secondly, we've then seen that with kind of cost prices and salary prices, standard of living prices increasing in the UK, salaries are increasing, and there people are hiring on a much more global basis. Now, before I touched on the point about creating permanent establishment overseas. Now, the relaxation, both of those points that I've raised being the relaxation of hiring policy, or relaxation of allowing individuals to work remotely, but also a global hiring policy, can then obviously trigger permanent establishments in multiple countries. And we've seen that across the board. My favorite example of this was a very well-known scaling tech company that is, I think it's Series C, two Series Cs actually, actually allowed all of its working force to go and work overseas, and they basically had about 250 people. And they turned around and they said, look, everyone, you can basically go and work wherever you like during the pandemic. And something like 60% of the workforce took them up on that offer. They thought it was absolutely brilliant. And it was only when the head of people then realised the implications that arose as a result of that, and that there was potential PE risk in multiple countries around the world, let alone the fact that there was payroll concerns, that they kind of phoned up and they said, have we done something that isn't quite right here? And at that point, we were like, yes, you probably want to change that policy and rein it back in. So we've not seen anything to that extent over the last couple of years, but obviously just an awareness is obviously important and prevalent. Touching on that, Emma, I think one of the key areas that we've seen as people hire people on a global basis is that there has been a kind of acceleration, and people are using employers of record now more succinctly. Is it worth us just touching on that for a minute in terms of the pros and potentially some of the cons where EORs are then included?
Yeah, so an employer record essentially has a back-to-back contract, so they will engage with your essential contractor / employee on your behalf, and then you'll enter into an agreement with them so that they will pay the payroll on the individual, collect the relevant taxes, then take a markup, and obviously you will pay them for the services that they are providing, including the staff costs of the individuals. So that they are great for, especially when you're just starting in a country, so you've got a limited number of individuals in a place, quick and easy, and they will manage the payroll obligations for you, so you're not having to do what's a shadow payroll, trying to work out what tax deductions you need to take for an individual based in a particular country that you identified them to be in. I guess the negatives of an employer record is they're great at looking after the individual's tax liabilities, the employment taxes, but they don't consider permanent establishment, which James was talking about earlier. So does the individual's role and activities in the country give rise to a permanent establishment, and therefore you have direct tax obligations. So it's essential to understand what the individual is doing. Will it meet an exemption? Where is the individual working? So I know some employer records will say that Joe Bloggs needs to work at their home address. Well, from a tax perspective, there's an argument there that you as a business now have rights over that home address, which could give rise to a fixed place of business. So we always recommend to make sure that the contract is quite vague as to where the individual can work. Like, they don't need to work from home. If they've got a laptop, they could go and work in a coffee shop. They could go and work wherever they like. Also, not providing them with access to an office space, even if that is a WeWork or some other kind of shared work area, because again, that will trip you up into the fixed place of business. And then if they're in a sales role or some kind of strategic senior role, again, that will increase the permanent establishment risk. So we would recommend, going to speak to your advisor to say, can we look at these individuals? What is the risk? is a permanent establishment going to be created? Is it better actually to have an entity in country and employ them through that? And I guess the other negative with an employer record is the cost. So if you've probably got more than 6 or 7 people in a country, the cost benefit of using an employer record versus having your own payroll is probably at that point worth considering. Should we set up a payroll?
Absolutely, absolutely. But the fact is that EORs are super helpful. They allow businesses to grow at absolute rapid pace, hire individuals on the ground. So there is a lot of positives come off it. Loving the fact that actually they take away a lot of the burden from a payroll perspective as well. The only other bugbear that I personally have with them is just a lot of the EORs use the same contract, irrespective of who you're potentially hiring. So as an example, you'll have the same back-to-back contract for a salesperson as you would do for a tech developer or a tech lead, as you would do if you hired one of the C-suites. But obviously their roles are completely different, and there are different protections and different considerations that need to be taken into account for each of those relevant individuals. If anyone needs any more content on EOR, there's a number of kind of written formats, but also some video content that we've shared recently on that topic, so let us know. The other point is where we're hiring new team members. I think it would be remiss of us not to talk about remuneration planning and share options. I think it's almost a kind of prerequisite now when you get senior hires into a business, they come with their expectations as to what share options are going to be on the table right from the get-go. So be aware as you're looking towards funding raises. So if you've either raised a recent round or if you're looking to raise a round, what the wider implications could be, both in terms of what share schemes may be available, but also what that might have in terms of agreeing any kind of strike price with HMRC in terms of valuations. It's really interesting in that regard where, we've seen multiple instances where if you leave it too late in the day to agree a fundraise, if you leave it too late in the day to agree a valuation with HMRC, i.e. the proximity to the next fundraise, it's going to be very hard to argue a discount against that fundraise. So always leave yourself sufficient time between going to HMRC, agreeing that valuation, and then subsequently doing that fundraise, likely to ascertain a lower valuation based on kind of business performance and the like. But obviously everyone needs to look at that on a case-by-case basis. It's worth flagging also that the implementation and the kind of the work around share options is probably one of the hottest areas that comes up during diligence, and unfortunately it's one of the areas that we see come up again and again. And we'll touch on that maybe later when we're kind of looking at some of the M&A stuff that we're going to touch on. I think the other area to just concentrate on as we're hiring, potentially looking to hire new people into teams, is the recent changes on R&D and potentially what impact that can have on hiring new people and where they may be. Emma, do you want to cover that point?
Yes, so I'm not sure you're aware, but from accounting period starting from April 24, R&D claims can no longer include overseas contractors or expenditure. So if the R&D is not carried out in the UK, that cost can't be included in an R&D claim. So I guess there's a kind of cost analysis to be undertaken. Developers in the UK typically are quite expensive versus a developer in other parts of the world. So it's, do I pay a developer in the UK more money, but I can claim like an R&D tax credit to offset against their salary, or do I forego R&D in the UK and have cheaper developers in another part of the world? So like, what is the salary of an overseas developer more or less than an individual in the UK doing the same role, including an R&D tax credit? So kind of thinking about that and kind of getting it early into thoughts processes of, we don't want to get to your first accounting period after April 24 and you're expecting an R&D claim of a certain amount, and then actually we've had to strip out all those overseas costs. So like that hiring process now, thinking about that change, that's very imminent.
Yeah, and just to be clear, that was never always the case, but it was always a little bit of a kind of, it was almost too good to be true that you used to be able to include overseas contractors, subcontractors in your UK R&D tax credit, because the whole purpose of the R&D tax credit for the UK was to incentivise and bolster the wider economy. So you could see why HMRC have kind of gone down that route. There is kind of one proviso at the moment which is being explored, which is you are still, well, this is draft legislation which is currently being debated, which discusses that if you cannot find the relevant resource in the UK to support you with your development of R&D, you can present an argument that that R&D should still be included, that overseas spend should be included within your R&D claim. My personal view on this is that is just completely open to kind of open to debate at the moment, but I think that it leaves it too wide open. How do you prove or disprove that that individual is something that, or someone that you cannot hire in the UK? So as we find out more in terms of that point, we will basically share some content on it, but it's too susceptible to aggressive planning in my regard, and I think that probably will be locked down given the tightening of the wider R&D considerations. Leads us on nicely to the third point, which is if you're going to then grow the business and you're potentially going to use any funding in terms of doubling down on tech development and tech spend. Now that can take multiple different kind of guises. Either it is very much in relation to developing or expanding your existing states of technology, or alternatively exploring and expanding different technologies that the company may develop. So going into new markets, trying to find new routes to market in relation to expanding the tech that you may offer. I think everyone on this call today is aware of the current and wider implications with HMRC's new approach to R&D inquiries. I think we've seen across the board, frankly, over the last year, very strong challenges from HMRC, not across all of R&D or not across all of tech, but we have seen heightened inquiries. So as examples, we've seen huge numbers of inquiries in terms of edutech. It was almost like a blanket that went out across the board in terms of all of the different areas in edutech, and really challenging, are these real advancements in the state of technology, and how are you benchmarking those, what are the parameters, really challenging those areas. We saw a lot of kind of e-commerce platforms also being challenged very hard, but also just a lot of software businesses. And there's obviously the problem that we have with inquiries is that obviously it takes up a huge amount of time and resource in order to kind of rectify those positions. We know that HMRC at the moment are very low in terms of resource. So actually it's super unhelpful, because we're in a position where HMRC are basically sending out reams of inquiries. You're then taking huge amounts of time to come back and then provide them with responses. However, they then are taking a long time to respond to you from a resourcing constraint perspective, which is putting a lot of pressure, especially if you're relying on those R&D tax credits from a cash perspective and built those into your forecasts. I think quite a lot of the businesses that we're talking to at the moment have kind of started actually removing any of the R&D tax credits from their cash flow forecasts, just making sure that it's almost like a nice to have. I don't think that the inquiries are going to go away anytime soon. Again, my personal view in relation to that is that there was just too many years of abuse in relation to R&D, and what HMRC have done is that they've attacked this aggressively in order to remove some of those areas. So with that in mind, one of the things that I think is quite an interesting discussion to be had is, if you are looking to claim R&D tax credits and you are strategically planning the year ahead, one of the conversations that we're having with a number of our clients is the definition of R&D hasn't adapted and changed. We know that HMRC's perspective and view on R&D has become more aggressive, right? So if we know both of those levers, could there be a better conversation? Because most people, and I bet on the call today, are probably in the position where they're retrospectively claiming R&D, right? And generally speaking, we're going back 12, if not 24 months, right, in terms of looking at and determining when R&D was undertaken, and then writing up the narratives and making the relevant submissions. Now, what that does, and we've seen this in the past, is there is then a lack of knowledge around actually what is happening. It's quite hard to pull together data sets in relation to that. So if you are looking at doing substantial tech spend, one of the things that our team have been doing is actually having wider conversations and actually thinking more strategically. So what R&D are you going to do in the next 12 months, right? And is that R&D potentially or hypothetically going to fall within the definitions of R&D from an HMRC perspective? And if they don't, what can you do to modify that? And how can you actually, when you've got a handle over it and you've got control, how can you modify what approach that you're taking so it's more likely that you're not going to get an inquiry, that HMRC are not going to pay out, but likely that you will fall within the definition of R&D? So maybe that's something that is worth exploring in a little bit more detail, having that wider conversation and then taking a little bit of comfort, because frankly, if you're in a position where you're back claiming R&D, which everyone has always done, because actually the approach from HMRC has been very different, this is now maybe where you want to be slightly more proactive in terms of the approach, and then come up with a kind of solution that says, look, these are the projects, maybe with your provider, these are the projects that I'm thinking about and working across and proposing that I'm going to work on. Would they, given HMRC's definition at the moment, fall within the relevant definitions? And if not, what do I need to do to modify those so that they can be, and therefore having that flexibility now in order to adapt and change. You know, let's move away from hindsight and retrospective, and given the current environment, potentially flip that into a position where we are being proactive in terms of some of the R&D. The other point, if we're talking about doubling down on tech development and spend, is just making sure, where is that tech development happening? Where am I creating that IP? I mean, you gave a really good example earlier where you could potentially have a dev center that's hired using EORs. We've seen that in the past, right? So we build up critical mass in an overseas country using EORs. My concern there is that, is there enough protection with the back-to-back contracts that the EOR has provided? Alternatively, if I'm setting up a subsidiary because I've got a development center overseas, actually, do I have, or am I ensuring that the IP is flowing from that, say, local entity back into the UK? So the legal and economic benefit, get my words out, the legal and economic ownership of the IP is where you want it to be. You don't end up, as you start developing technology in multiple different countries or jurisdictions, having IP in multiple different places. We've seen that also as people expand into new territories and they set up sales operations, they may change and develop elements of the technology for local markets. Now, again, the question that you want to ask there is, do you want that, or should that IP fundamentally be passed back up into the parent company and considered more widely at that point? Good stuff. Right, let's move on. I'm just conscious of time. We've got about 20 minutes. I've noticed that no one's put any questions in the chat bar yet, so either we've got quite a bunch today, or you're all saving your questions for the end. Either work for me. The other area, if we're looking at kind of strategic growth, is kind of non-organic growth. So can we have some strategic acquisitions? Are there ways of bolstering growth through potential targets that we may look at? So we know that the kind of established route in terms of growing a business can be quite slow, and therefore, is there a way that we can accelerate growth by looking at non-organic? So what can I do? Are there differences and elements in terms of how I can grow businesses? I.e., is there other businesses that are complementary and there'd be synergies across the board? Or alternatively, are there differences and distinctions if I were not to buy an entity but looking at the trade and assets? Emma, what do you think are the main considerations when you're looking at that distinction and differentiation between kind of a share asset purchase versus trade and assets?
So I guess a trade and asset sale from a kind of commercial, like, historical thing. So when you buy the trade and assets of a business, you're buying the trade and assets of them, what's there now. So you won't have the historical exposures to the business because they will still remain with the business that the trade and assets were originally in, and when you purchase them, you'll just get kind of the good stuff, and you kind of can leave behind what I would call the bad stuff. But I guess you've got to find, where would you put those trading assets into your existing group? Would you actually want to include them in your main trading entity? Should they be sitting somewhere else within the wider group? And with a share acquisition, I guess you have the historical exposure, so you would need to probably do more DD into the entity to determine whether there are any kind of key tax risk, commercial risks that you're going to be taking over. From a seller's perspective, they're probably going to want you to go down a share acquisition route, because with the trading assets, they're left with kind of a shell company and the cash sitting inside that shell company, so they have to find a way of kind of getting that cash then out of the business. So commercially, when they're selling, they might want to push towards the share acquisition route, whereas you might want to be trading assets. There might be also commercial reasons why you need to buy the shares in a business. So it's working on a recent transaction where it's an insurtech business and the company needed to have the sub because they couldn't change both the broker and the underwriter in the same period without then renewing all the contracts on an auto thing. So there are normally wider considerations as to whether it should be a trade in assets and or a share acquisition.
Yeah, that's a good point. Especially, let's just touch on that point as well. If you're looking at potential international targets as well, you just want to think slightly wider there, because one of the areas there is, if I were to say, if I found a business that I thought and it was a relatively IP rich business, if I'm looking at that target, and let's say that's in France, there are basically two routes there. So the trade and asset route for me, in terms of buying the trading assets of the French entity, would be advantageous, because immediately the UK business, assuming I'm a UK business, the UK business would be able to encompass that trade and assets from the French business directly into my business, and therefore I can get going from day one, right? Whereas if I was to do a share purchase, I'm buying the French company, and then I have the French entity then in my group, thinking about the structure of the group. If I then subsequently want to move the IP out from France into the UK, the likelihood is after the transaction, I'm then going to have to move that IP from France into the UK, which can then give rise to exit or migration charges of IP moving between countries. So just having an awareness of that is going to be really important as well. It's just worth touching on this as well. Emma, we've worked on a large number of transactions after we've probably seen back end of last year, transactions are now coming back into force. Just give us a quick kind of summary as to kind of some of the top trends that you're seeing on transactions at the moment.
So probably the first one is tax residency, which we mentioned at the start of the call. It's something when it goes wrong can go very wrong. So we've had it where we've had no board meetings, all the board meetings have been at group level, or in another transaction I'm working on, it was a subsidiary, they wanted to exit the UK market and our client wanted to expand in the UK, so wanted to make the acquisition, and all the directors were based in Germany and weren't visiting the UK, so we've got a UK company that could potentially be German tax residents. So it's not just UK tax residency rules, but wider considerations kind of around the group and the implications on that. The next one is share options. So we've seen lots of very interesting things on share options, from granting shares over a class of share that didn't exist at the time. So they decided that they were going to grant options over a C class of ordinary share, or ordinary Cs weren't in the articles. So there's nothing for them to grant over. So these individuals were hoping on exit that they were going to get a nice amount of money when they exercise their options. It was not even unapproved. There's nothing to exercise, so the individuals are going to walk away with nothing. So there's discussions at the moment about paying them a cash bonus, which is now going to be taken out of the consideration with the tax as well. So not ideal. So making sure you've got your share options in play, that they're how you expect them to be. So when you get to that DD and that transaction, there's no mad panics at the disco and very expensive solutions to something that could be quite easy if you get it right in advance.
Yeah, that's a kicker, isn't it? We've seen that happen on multiple occasions, where the expectation is that you're going to have some kind of EMI scheme in place and there's going to be a tax benefit at, say, 10%, so you're taking 90% of the proceeds home. But actually, when it doesn't qualify for EMI, or in your example, when there's not even a share option plan in place and you've got to pay out a bonus, we're talking like PAYE at like 45 to 50%. Like that is a hard pill to swallow. And generally speaking, depending on the nature of the transaction, if that's like if it's a trade sale, PE deal, generally speaking, you're looking to incentivize those individuals over in the future, and therefore those are the people that you want to make sure have a sweetener, so that when they roll into the new transaction, especially if you as a founder have an earnout, they're coming with you on that. In order to do nothing, that's basically writing the check, isn't it? It's like basically saying those guys are not going to come with, because so you are, and we've seen it on too many instances where these share option plans have gone wrong, and therefore someone needs to kind of step in and kind of actually basically offer an alternative coming out of founders and existing shareholders' pockets, which is exceptionally expensive. The worst ever being where we saw an instance where grossed up bonuses had to be paid out. So it wasn't even they paid out bonuses. They paid out grossed up bonuses, so that the individuals, instead of paying out 100k, right, and then the individuals walking away with 50k, they were like, no, we'll pay 200k, so you walk away with 100k. It was like eye-watering, and that came straight out of the founder's pocket, which was enlightening to find that as the answer. We can discuss again as to the why that happens, but let's move on, because we've already got about 10 minutes left.
I guess the final one that we're seeing a lot of is R&D. When we mentioned earlier in the call about the increased scrutiny about R&D, so because of that increased scrutiny during DD, it's getting a lot more. So before, people would say, oh, you've received your R&D tax credit, fine, tick, like we're not going to test it any further. Because HMRC are opening inquiries after they've paid out, DDers are not happy with just accepting that, yeah, you've got your R&D claim in, you've got your credit done. They're like reviewing those R&D claims to make sure that your narrative report actually explains what R&D activities you've been undertaken. Are the percentages reasonable? So they're almost doing a higher level of testing than HMRC, because the concern is that HMRC will open that inquiry and then do that testing at a later date. So what was previously probably given from an R&D tick, we'll put it in. Now there's a lot more scrutiny about what you're claiming, what have you submitted to HMRC, and price adjustments. And then I guess the other thing is we've had on a transaction fairly recently was, is it an SME versus an RDEC? And this particular deal, they claimed SME. We looked at it and it was determined actually to be RDEC. So when HMRC, they had to make a voluntary disclosure to HMRC saying, oops, we've claimed under the wrong scheme. HMRC then looked at it and goes, actually, I don't think you've done R&D at all. So kind of the deal fell over. So it's important that your R&D claims are strong and up to scrutiny, because they are going to be looked in a lot more detail than historically they were.
Absolutely. Andrew's asked a question in the chat bar, by the way. He said, if you have a local entity, are international virtual board meetings sufficient, or do you need to have local in-country board meetings? So Andrew's referring to the tax residency point that Emma raised before. Do you want to address that, Em?
Yeah, so virtual meetings is probably, you could have some of them, but what we would always recommend that you have at least one board meeting a year in country where the directors are physically there, so that in that board meeting you're kind of approving the accounts, you're doing like key strategic things. So we never suggest that, you know, like you need to fly around the world once a month to be able to have those board meetings, but once, twice a year, and to discuss stuff at like local level covering that entity. A group board meeting is not going to be sufficient to cover off the whole group's residency points. You need to have those local board meetings in country.
Thank you for that.
Thank you.
Cool. Christian's asked a question as well, which I can address. We probably it's not the easiest one to answer, but it says, how would you go about setting an internal price for a SaaS product between group entities? Let's say the external pricing is £100 and gross margin is 80%. There's a number of ways that you address it. So this, Christian, is a transfer pricing question. it will depend very much on, let's go back to an example. We've got UK business, we're going to set up a US entity, we're going to put the revenues through that US entity. It will fundamentally determine the determination of the pricing between those entities. Well, and so the transfer pricing and the pricing thereon would be dependent on how entrepreneurial that US entity is. So it will either fall within either being what we refer to as a limited risk distribution model or a fully fledged distribution model. There are a couple of other models that it might exist as well. It's not the easiest thing to answer quickly if you need to have a separate conversation about it. Generally speaking, if it's a limited risk distribution model, it is less entrepreneurial. It's reliant on quite a lot of like the IP from the parent company. There is central management control from the parent company. There's probably an element of financing from the parent company. And what we generally look at there is providing a composite charge from the UK business into, say, the US entity, and therefore you leave behind a relevant margin. That's a well-trodden path. It'd be expected that would be the case. As the business became more entrepreneurial, you then don't have that composite service. You then start to have delineated costing for each of the different areas that you benchmark. Now, interestingly, with the limited risk distribution model I touched on there, you generally end up with a small profit margin, which would be the expectation of if you were working with an external third party, right? And that's kind of using the example that we've got. The IRS would accept that in their approach. Yes, we can see there's a small profit margin here being left behind, somewhere between 3 and 5% is a general rule of thumb. With the more kind of entrepreneurial entity, the fully fledged model, you are in a position where you can start to generate losses quicker, right? And actually you can be in a position where that does generate losses by having those separate streams of work. However, and this is the big however, you need to make a decision quite early on, which is, do I go down the limited risk model or do I go to the fully fledged model, right? Because if I go to the fully fledged model too quickly, then actually, yes, initially I can start to book initial revenues. I can book initial losses, but at some point you will then transition to a level of profitability pretty quickly based on the expected revenue growth of the business. And therefore, you need to then balance up the kind of question, which is it right for me to then move into profitability in that country and therefore pay additional taxes, as opposed to staying with that limited risk distribution model and fundamentally only having a small skinny margin for a period of time. Again, good conversation to be had and one to be considered. There are other models that can be looked at as well, depending on where your sales team is and also what they're doing, which we slightly touched on before. Cool. All right. If you want to have a wider conversation, let me know. We can talk about that in more detail. So we touched on, the difference between share acquisition, trade and assets. Just be aware, obviously, as you're buying potential targets, there's obviously periods of integration and synergies across the board. We touched on where is the acquisition target that can play in as well in terms of some of the wider considerations. Emma, you touched on as well, like, you will have an approach, right? So when you go to market in order to go and raise that, when you go and look at targets, there'll be a different perspective, right? And you need to go into bat, which is, this is what I want from a business perspective, but the shareholders potentially will want a different answer to that as well. So just an awareness of that, because that will play into the deal considerations and the debate that you'll have as well. Let's just move on. I'm just going to do a minute and then open up the floor for any other questions. So we were going to touch on additional non-dilutive funding. So additional non-dilutive funding is where we're using some form of either venture debt, we're using potentially CLNs, we're using potentially warrants. And generally what we're looking at here is people are using this either as they've done a funding raise recently and then extending runway by virtue of bolting on additional bits of venture debt, so you've got it therefore extending the runway, or alternatively looking at non-dilutive funding at the moment as a stopgap between now and the next fundraise. I think there's quite a lot of there's a lot of uncertainty with fundraising at the moment. We're still seeing that it is challenging, and therefore in terms of and questions have to be asked around valuations attaching to those fundraisers as well. So we're seeing quite often that Series Cs are being pushed out further, basically based on the fact that those kind of the quantums being looked at to be raised at Series C are potentially more challenging in the current environment. We're seeing a lot of what I refer to as an A bolt-on, a B bolt-on, an extension round, but also then looking at alternative ways of funding the business over that period of time. I was going to touch on some of the tax benefit or tax areas that need to be considered alongside that, but I'd rather just pause at that point and just ask if anyone's got any questions on any of the areas that we've covered today, or if there's anything else that anyone wants to ask. Either pop it in the chat bar, or do you want to come on camera and ask the question directly? So.
James, maybe a question for me, Christian. I think I actually asked the question the other day, but we didn't have time to. You didn't have time to answer it. If you suddenly are in a situation where you have a permanent establishment in the country, how do you practically go about, filing returns, splitting up? Because I guess you have booked everything in your headquarter and your English entity. Suddenly you have an entity or a liability in a certain country. How do you practically go about splitting it out, and how do you satisfy those? And what about then the taxes in the UK? And just some highlights. I know it's a bigger question.
Of course, I'm smiling because this is my least favorite question. Emma knows this. This is the least there's loads of things that I hate that come up during a transaction, right? Being a diligencer, like, you do come across things that are just awkward and nasty. This is one of them, right? I really dislike it because actually there's quite a few processes and thoughts and considerations that comes up when you determine that there's a PE in a country. Okay, so let's look at this in a bit more detail. So let's make an example, which is, right, we're looking at a business that we look at it and we go, right, actually we think that you've got a PE. Let's base it in Spain for argument's sake. We've got a salesperson who basically is negotiating and concluding contracts on behalf of the UK business in Spain. Okay. What you then have is a position where you then need to step back from the situation. So there's a bit of a logic tree that we need to work ourselves down here, right? So the first thing that we stop, we go, right, have I created a PE? Answers are yes or no. In the example that I've given there, the answer is yes, we do have a PE because we've got a salesperson who's got an agency PE in Spain. Right, fine. Then, if that's a decision, the question that we would ask if we were an advisor at that point and we've got time on our hands is, should we look at this as a branch or should it be a subsidiary? Okay. But generally speaking, at that point, we're kind of skimming over that when we're looking at it from a transaction perspective, because irrespective of if you're going to have a branch or a subsidiary, you're going to have to think about what the accounting should be or should have been for that entity. Now, generally speaking, what you're going to do at that point is you have to do some kind of profit allocation. And by profit allocation, you've got to think about what would be an arm's length, or basically an arm's length charge in relation to the activity that's undertaken in that relevant country. Now, as an example, let's take the example we've got there and extend that out. So we've got a sales individual in Spain. We therefore would need to think at high level the transfer pricing in relation to that relevant individual. So what would be an arm's length charge? So it's not as simple as just doing a cost plus exercise with the salesperson. If you've got dev teams, then that's probably easier to do. But with salespeople, you've then got to think about what an arm's length charge would be. How would you price that accordingly? And therefore what the profit in Spain and the PE in Spain would likely look like. So there'd need to be an exercise undertaken to determine that was the case. If this was during a transaction, we would then have to think about, right, how long has that PE exposure been there for? And what is the likely profit that's arisen as a result of that? If we've got salespeople, the answer is going to be almost definitively there is going to be profit, because based on the kind of mechanisms that we need, it will generate a profit in that country. So then what you then do if you're under diligence is you then have to work through all these different areas. You come up with what the potential tax exposure is. You'll then apply 100% penalties and interest, and that will be the answer that you give. So, Christian, I hope that gives you a kind of ridiculously whistle-stop tour in terms of when we identify there's a PE in a country, how you need to look at that and some of the wider considerations that need to be taken into account. Cool, thanks. Anyone else got any other questions? Happy to hang on for a couple of minutes and answer any other questions that anyone has. No. Well, as I used to say at school, class dismissed.